Equity Trust Company is a passive custodian and does not provide tax, legal, or investment advice. Any information communicated by Equity is for educational purposes only and should not be construed as tax, legal, or investment advice. Whenever making an investment decision, please consult with your tax attorney or financial professional. Equity does not endorse any speaker or presenter before you today. The opinions or ideas expressed are not necessarily those of Equity Trust Company, nor do they reflect their views or endorsement. These materials are for informational purposes only. Furthermore, all case studies provided are for educational purposes only. Past performance is not indicative of future results. Investing involves risk, including the possible loss of principal. Because of the technical nature of the material and the fact that the laws and the markets are ever changing, we strongly recommend that you engage the assistance of a competent, qualified professional before implementing any ideas discussed today. Thank you.
Our next speaker is Eddie Speed. So a little bit about Note School and Eddie Speed. This is unusual. Usually it's Eddie or Joe or one of the other guys introducing me, so I have the honor and privilege to, I think for the first time, introduce Eddie. And Eddie's been in the note business since 1980. And he'll likely talk a little bit about it as well in terms of the billions of dollars in notes that have come across his desk, as well as his Director of Operations, Bob Repass. He'll likely introduce his team in his presentation. And he has a company, an education company by the name of Note School. Who's, by show of hands, a Note School customer, Note School student? We have a few in here. Who's been to a Note School boot camp, one of their 3-day boot camps? If you have an opportunity to go to a boot camp, you'll likely see either myself or one of our other Equity Trust representatives. We go to the Note School boot camps and talk about using self-directed IRAs, because at the Note School boot camps, the 3-day workshops, they teach self-directed IRA strategies. And a lot of that is because Eddie is as passionate as he is about investing in notes with self-directed IRAs, as well as his wife, Martha, who's in the very back. Martha, if you could maybe wave so everybody sees you. That's Martha, Eddie's wife. And she is consistently processing self-directed IRA note deals through Equity Trust Company. So he's going to talk a lot more about how you can get involved and how you can learn more about the note business. And I don't know if he has it in this presentation. If he doesn't, you can check it out at one of their boot camps, or I know they have other mediums for information. But he has one of the slickest strategies or tactics in the industry, and that's taking a small amount of money in a Roth IRA, $500, even $100, and buying a note with a private investor and selling partial payments. So I'm really excited to introduce Eddie Speed to the platform. If everyone could join me in welcoming Mr. Eddie Speed. All right, you take it away, sir.
Thank you.
Yep.
Well, it is a thrill and a joy to be here. First of all, it's a great crowd. I hope you've had a great time. This has been a super impressive event, and I want Equity Trust to realize what a good time we've had, and I want to thank them for that. Let's give them a hand. This is a lot of work, and this is a lot of benefit to all of us, and I really appreciate it. So I've been in the note business since 1980. I've bought about 40,000 notes. My executive team has bought about $3.5 billion in notes. So the reason I make that statement to you is because when we built Note School, it was after 20 years of being in the note business. We're not some slick guru that did a deal a few times and then wrote a course on it. We have currently about $50 million in notes under management. So we are active in the business today. My wife, as far as I know, my wife has probably done more transactions where you buy the whole note and you sell the front end of the note and basically recoup most of your investment, and she owns the residual back half of the note in a Roth IRA. She's probably done more of those physical transactions than anybody in the industry. So we are teaching from experience. And if experience matters, and I believe it does, then I'm honored to be able to help you and help you progress in the business. I have a flyer that I've handed out. We will talk about how you can progress with a class, and I have some pretty insane things that I'm going to give you. You don't have to study that the whole time. I just wanted you to have it and have it available. So what does Note School do? We teach various aspects of notes. How to buy a property with a note, how to sell a property with a note, how to buy somebody else's note, how to buy a loan that isn't paying and a loan that is paying. All of those things are things that we do inactively. But what the heck is a note? Everybody in this room has been in the note business. I'll guarantee you, if we pulled out a dollar bill and we read the fine print, it would say this note is legal tender for all debts, public and private. A dollar bill is a note. What else is a note? Yeah, a check. If you've ever written a check, you've written a note. If you've ever accepted a check and deposited a check in the bank, you've sold a note. So to get all of this stuff out of our head, notes are somehow more complicated. They're not. It's a promise to pay. Now, we're going to talk about today installment notes, notes that are payable over time. Installment notes. A check is called an on-demand note. You present it to the bank and you cash it immediately. What's a discounted note? Anybody ever heard of a check cashing service? What do you do when you go to the check cashing service? You go in there, you hand them your check for $1,000, and how much do they give you? $1,000? What? You must be kidding. They give you $800, $850? It's not a fee. They buy your note at a discount. They turn around and put it through the bank, and how much do they get? Does it make any difference whether they would have paid $850 or $50 insofar as what they're entitled to collect? That is a discounted note. We buy notes at a discount, but we're entitled to collect the full amount owed on the note. What we pay for a note is irrelevant to what we're entitled to collect. Does that make sense? Okay, so let's talk about this relationship. You got a buyer of a property, a seller of a property, and the buyer conveys ownership. Now, I am extremely familiar with a land contract. This isn't a lesson in land contracts versus notes and deed of trust. For all of you here a little more seasoned in here, this is a note and mortgage transaction. It's not a land contract, but essentially an IRA, it can be a SIDRA, a SEP, a Coverdale, homes or health savings, any of those transactions you can do with a note. We have a lot of experience in this area, and I'm going to give you a case study and show you just one today. Note School also teaches you how to buy property where the seller of the property, seller finances it to you. If you're taking notes, what you're going to learn to do is to dictate the terms to your lender. Now, how many of you would like to go into the bank and tell the bank how you want the loan to be? Starting out with low or no interest, starting out with the fact that there ain't going to be no personal guarantee, and that he's going to be willing to move the loan from this property to another property, and that you have the first right of refusal to buy the note forevermore. That is dictating the terms to your lender. We have come up with over 40 different things that are dictating notes to your lender. Real estate investors cry the blues. We'll talk about it. We'll talk about the biggest fix in your real estate investing today is approaching a different way to buy property when the seller has rejected your offer. So Note School is going to talk about two specific things today. We're going to talk about buying notes in your retirement account, and we're going to talk about seller financing. So first of all, let's talk about your retirement account. Here is a note that's seller financed, and here is a note investor. Potentially everybody in this room can be either of those. That note is, the lender sells that note at a discount, And then the note transfers ownership to who? The note investor. Why do people like notes? Why is paper so doggone good?
The toilet doesn't clog.
Counselor, you are right. You know what? The thing about notes is particularly in working class property, whose cycle time of likelihood of staying in the house is a shorter cycle time than a higher price band of property. 2 years into it, maybe 3 years into it, you get to start all over again. 2 or 3 years into a note, it just gets better. So a note produces payments over a long period of time. The longer it pays, the safer it tends to become because it's more seasoning and more likely to continue to pay. And then what you get is you have one transaction that can produce 30 years of income. If you are a busy person in your everyday life and you're not Eddie and you're not Vina and you're not sitting in front of deal flow every day, most people really love notes because it lets them deploy their money at a good return and they don't have to go find another deal for a long time in the future. That is a big advantage. So, you work once, you got long-term income. So when we look at a note, there's really 3 characteristics of a transaction that you want to learn. You got the buyer, you got the loan, and you got the collateral. So if we're buying a note, there's 3 things we focus on. What's the likelihood this old boy's going to pay me? What does the note call for him to pay me? And God forbid if he doesn't pay me, what's my collateral? Will they pay? How much will I be paid? And my security. That is pretty much note buying 101. Now, I noticed you were a little bit stiff a while ago. Vina said some kind of pretty funny stuff. And you weren't really laughing in the way you really should have been. Okay? So you're going to have to work with me a little bit here. Okay? So if you're a real estate investor, this is a tongue-in-cheek thing. I'm not making fun of what you do. I've spent my career working with real estate investors. I've been around, the people that taught me the business were real estate investors. My wife's been a real estate investor. I've had clearly over 4,000 or 5,000 properties myself. So, but I'm just saying to you, they make TV stars out of these guys called bird dogs. So you start out as a bird dog, and then you grow up and you're a wholesaler. And then you graduate to be a fix and flipper. Now, if you're bigger in the food chain, you get to be called a landlord. And in my mind, all of these things are not number one. Because the guy who is the most creative gets paid the most. And that is what I call a deal architect. So what does a deal architect do? Well, first of all, he sees what others don't. He does what others don't know how to do. And he reacts when others are following the herd. So I'm going to give you 2 different business models today. 2 completely different business models today, both of which are being a deal architect. And both of which are doing everything that you see those bullets say. They're doing things that people don't do, and they're not following the herd. This guy's name's Brooks. He is a software engineer by trade, and he lives over in a close friend of his. He says the great state of Raleigh. This asset right here is located in a little old town in Ohio called Cincinnati. He bought this loan on a website. There's bad ones and there's good ones, but this one's a good one. I'm not getting into all that today, but I'm telling you that's where he found it. Okay? He went to note school and he understood how to evaluate his investment. The one thing why I need to get you to come see me at a class is that we're going to have time to break it down so you can build your scales, negative and positive. And I have never seen a perfect deal yet. Every deal has some negative, and every deal has positive, and we got to figure out when the positive is so significant that it outweighs the negative. They don't make any perfect deals. And in our business, we live in the world of imperfect. That's why they seller financed. So this property was a duplex and had a gross income of $1,400 a month. Okay? It had a good pay history of 16 months, and it was in a solid, safe neighborhood, and we had a title search, and the title was good. Taxes were paid, title was good. There was a negative in this deal. Oh, property taxes were paid. The broker price opinion came in low. Property sold for like $65,000, and the broker price opinion came in at $50,000. Now you're saying, how in a safe neighborhood could you have a broker price opinion that came in for $50,000 when it's a duplex and it rents for $1,400 a month gross rent? That's why the realtor got paid $35. I'm just telling you the truth. But in that process, he recognized the value was really more than $50,000, and he seized an opportunity because of a negative factor in the deal. And that's kind of what note buying is. So you got the note itself. He owed $62,997, 7.9%, 224 months, $538 a month, and he bought this in, yes, a Roth IRA. Okay? He paid $42,000 for that note, and it was paying good. So his investment was 42%, or $42,000 on a $63,000 note. Okay? Why did he buy it so cheap? Because of low BPO. He bought it so cheap because the broker price opinion came in low. Most people would see that as, oh my God. Listen. That BPO wasn't nothing more than a property inspection. That wasn't no more the value of the property than a man in the moon, and Brooks understood that, and that's why he seized the opportunity. I'm not disregarding every BPO. I'm just saying to you that with that kind of income in a safe neighborhood, he knew there was no way it was only worth that much money. I can have time in a 3-day class. I will explain to you why the BPO came in low and why that is characteristic of transactions in our business, and therein lies an opportunity. So here's the loan. He had made 16 successful payments on the note. Those were already paid. Would you say that's a redeeming factor? Good pay history, right? He's got 224 payments remaining. He buys those 224 payments of $538 each. The loan balance, or the debt, was $68, and the BPO came in at $50, and now he's at 80% of the value of the property. So he bought the loan at an inordinate discount because the real estate broker came in with a low valuation, right? There was the opportunity. He buys this note for 65 cents on the dollar, and his price is $42,000, right? Why was it so cheap? Low BPO. You're saying, Eddie, you keep repeating yourself. This is how note buying works. You learn certain rules, and they become part of your DNA so that when you need to understand a foundational principle, you have it in your head. Now listen, at this point, he's got the note bought for $42,000. He's got it in a Roth IRA. He could have immediately flipped it, got a new BPO for probably about $70,000. He could have went back out and flipped it and made fee income. He could have done it in his personal business, or he could have even done it in some way, shape, or form creatively in a retirement account or an HSA or a Coverdale or you name it, right? So he could have flipped this note and made $6,000. Okay, I'm not an anti-note flipper. I paid for my cars and our house and my kids' clothes for a long time flipping notes. I'm not anti-fee income. So sometimes you need to cash a check and make money. And so on this deal, Brooks decided he didn't want to do that. Brooks could have flipped it. So if you're looking at fee income, that is an option he had. This is a picture of an amortization schedule. The orange picture is the debt that's owed. The green picture is the investment portion of his deal. So he bought the note at a big discount, right? See the top of the green to the top of the orange? That's discount. What Brooks completely understood was that the chances of early payoff were high, and he had a chance to earn the difference between the orange and the green. What did the accountant call that? Unearned discount. So he buys the whole note in his Roth IRA, and he's got this strategy that he learned from this old Southern talking boy named Eddie Speed. Okay? He sells a payment stream on this note of less than the whole note. Meaning that he's going to then collect what down the road? Future payments. So, if I had a pizza shop and I was going to make profit, it cost me $6 to make that pizza. There's a couple of quick ways we could think of we could make profit on that deal. The first one would be sell it for more than $6, right? And the second one would be what? You got it. If you can do it to a pizza, you can do it to a note. Okay? So he understood the concept of selling half his pizza so he could get his money back. So I'm giving you a little color coding here. Orange is the whole note, green is the amount Brooks invested, and blue is the amount of the partial. So I'm going to show you some pictures. Just kind of get that color coding in your mind for a second. Brooks comes in and buys the whole note for $224,000. Excuse me, for $42,000, he buys 224 payments at $538 each. He collects 4 payments. He could have flipped it at the closing. He didn't, but he could have. So he could have gotten his money back immediately. He didn't need his money back immediately. So he didn't, like we could recut this deal, but this is the deal that he did. And you're going to have the freedom to do the deal that you want to do. The second thing is, he sells 100 payments to a passive investor. So there's a passive investor that didn't find this deal and doesn't know how to put it together. They have anxious money that they want to take out of the stock market, and they're looking for what is called an alternative investment. Financial planners call them alts. And this was a classic example of a passive investor, and they fund for the partial $42,000 for 100 months. So then he sells that. They're going to get back 53, which is going to give them like a 6% return. 6.16 is what my HP calculator says. You know all this is just an estimate, right? Okay. Then, what else does he own? He owns the back 120 payments of the note, and we'll call that residual income, which throws back out to him $64,633. Brooks did not need a hammer to make money as a deal architect. His tool belt would have been a liability. Now you're going to see the graph, and it's got the orange, which is, do you remember what that is? That's the whole debt owed. Right? Principal, and as it goes over time, it just shows you that the principal is reduced. So obviously it's more interest on the front end, less principal. The blue line is the partial investor's amortization, which was 100 months. And Brooks, at the end of 100 months, gets the note back, and they're going to owe him about $45,000 plus interest for the back 10 years of this note. You see that you got this deal going for you? Now, is that a good deal? He's got his money back. He's collected 4 payments. He's about $2,400 to the good. And he owns the back 10 years of this note. And by the way, this is a pretty dang passive deal for Brooks. So this is a typical normal deal that my wife would do on a regular basis. Like regular as in regular with a capital R. Because we have a 401k, we have various retirement accounts, we have kids with retirement accounts, we have a number of different people that she's putting this in our family network. And our employees think that working for Colonial is a pretty cool thing because Martha can use a leveraging strategy where you don't even need a calculator. It's just good. Right? What Brooks knows is the difference between the blue line, the difference in the top of the orange line is money that he would get if it what? If it paid off early. So Brooks understood this strategy. And guess what happened? You ain't gonna believe it. 9 months into this partial investor, this bad boy pays off early. And that, between the bottom of the blue line to the top of the orange, shows you who gets what. The payoff of the loan was $61,321. His partial investor got back $39,000. Brooks gets the difference between the whole payoff of the loan and the partial, and the calculator says $22,288. So in a year, he's gotten $22,200 and $2,400. That's knocking pretty close to $45,000. Y'all think Brooks is a deal architect? That's what I want to teach you how to be. I want you to cross out Brooks's name and put your name in that spot. Brooks would not tell you that he's inordinately smart. He's not inordinately rich. I will tell you this, he absolutely spends 6 months out of the year on a sailboat. Because that's why he liked this business, is he can make money that doesn't require him to be in the grind like he is in other real estate strategies. How many of you in the room consider yourself a real estate investor? Just curious. Full-time, part-time, doesn't matter. Like 80% of the room. How many of you would be a real estate investor if you could do it in an insane strategy like most people didn't know how to do? Now, who in the room wouldn't raise their hand to that? Okay. I know if you're a real estate investor today, I know if you're trying to buy properties, you are probably saying we are struggling with what? Inventory? Huh? If you're a real estate investor today, unless you're buying in Gary, Indiana and Jackson, Mississippi, which is worse than Cleveland's low-end stuff, then you are struggling. And by the way, how easy it to find cheap inventory in Cleveland and Cincinnati on really nice houses in really nice neighborhoods. A problem? It is the industry problem. It is definitely the, I'm going backwards here, sorry about that. It is definitely the elephant in the middle of the room. And if you don't know that, you're not active. If you're active, you know it. Now, I got a fix for you. Listen, I got a fix. It's your offer to accepted ratio that's your problem. Your conversion rate. 2014, a guy that's in this mastermind, he told me that in 2014 they were making 12 offers to get a house bought. And in 2016, they were making 15 houses to get a house bought. And he said, now it's north of 20. So I just went safe with 20. You're making 20 offers and getting one yes. And the reason you're getting one yes is you're a one-trick pony. And that is you're paying cash at a discount in a market that doesn't want to do what? Discount. So you could then double your conversion rate if you know how to do what? Buy on terms. In fact, I challenge you, you probably could triple it. All you got to do is hit 1 in 19. There's 19 people you're leaving unharvested. People that sell a property have two issues. I'm going to put them in two categories. You have people that have a money problem, and you have people that have a real estate problem. And after 38 years of working with pretty solid, the biggest fix and flip guys in the whole United States for a long period of time, more people have a real estate problem than they do have a money problem. Am I right? You're shaking your head like you've lived it. You've lived it. You can solve a real estate problem and give them exactly what they want. So you get down to this situation you're at, you got the buyer and the seller. How do you pay full retail and how does that equal a bargain? And I will assure you, I can buy at a way deeper bargain basement deal than paying cash on the market today at 68 cents and 75 cents, and in hot markets they're paying 80 cents for flips, and that is insane. And you do it because you understand how to dictate the terms with seller financing. So, I'm going to show you some properties. I'm going to show you some pictures really quick. We're just going to kind of flash through them, okay? Every one of these properties were seller financed. Common thread. Every property I'm showing you a picture of was sold with what? Seller financing. So you got Georgia, Wisconsin, Illinois, Louisiana. Where's that? Georgia? Texas, Florida, Indiana, Connecticut. Oh, y'all like these houses, by the way? Every one of these properties were seller financed, and the other common thread is they were all sold at zero down. Next set, all seller financed. Ohio, Kentucky, Texas, Florida, New York, North Carolina, Virginia, New Jersey, California, Washington. All of these were sold with seller financing, zero interest. The last 1,000 one-off mom and pop seller for notes we priced, 18% of them were written at zero interest. Don't tell me somebody won't do it. You see, how I know this so well is because my executive team has bought $3.5 billion in owner finance notes. Now, you couldn't take any other bench in the whole United States and come close to that number. People that work with us now came from these big institutions that were buying $2 and $3 and $400 million in owner finance notes a year. Now, Tracy would tell you, from being an executive on Metropolitan's team, that if you bought one, you looked at about 8 more. So we've seen a lot of deals. And they just show up with a little bell on top of them. Because the ones that you see that they wrote under crazy terms has a common thread. The buyer dictated the terms. You got to understand what you are negotiating for. If you don't understand what you're negotiating for, you're not going to negotiate the best deal. This property in Tennessee, Georgia, Texas, and Georgia, all of these properties were sold with seller financing at both zero interest and zero down. People think the only way you can go buy distressed property today at a deep discount is you got to go buy the junk, and that is not true. You got to find a motivated seller that has a what? A real estate problem. And you can crush your competition because you don't have to go buy at a discount. Sometimes zero down and zero interest won't work. That's a one-trick pony. Sometimes it won't work. You got to be smarter to know how to structure deals in different ways. So I got this student. He said, I've done so good in my part-time note stuff that I've left my corporate job. The problem is I'm getting married and we want to move into a house that we own and I'm not bankable. I said, congratulations twice. I said, because the lender is not going to dictate the terms to you. You're going to dictate the terms to your lender. So he gets a campaign together on on free and clear houses. You wouldn't have to do it this way, but this is what he did. He mailed 550 letters. He got 5 responses, and he bought a house of 1 in 550 letters. And in the letter, he baked in the information that said, I'm a young guy, I'm getting married, I deserve a chance, and I need somebody to seller finance me. So people call him, and this is the duplex. And it rents for $1,500 a side. So what if I told you that I had a student that was so bold that he would go in there and say, I'm going to buy a property, and I'm going to have the tenant pay for my mortgage payment, and I'm only going to put $5,000 down, and I'm going to buy in the hottest real estate market in the United States. Would you say that sounds impossible? It ain't. If you are a deal architect, your only limitation is your imagination. So I'm going to set this up, that how life's really going to work for you when you start doing this. Okay? I'm going to set you up, and I'm going to show you how things are going to morph as you're doing this, because this is what's really going to happen in real life. The seller's going to have wants, and we're going to put those in red, and the buyer's going to have wants, and we're going to background those in black. So as we look at the deal, this is how it's really going to work. The seller's going to have a something, and you, the buyer, better have a something. Remember, you got to know what you're negotiating for. The seller insisted on the sales price. I'm not discounting my house. Oh, wouldn't think about it. My student says, I'm only going to pay $5,000 down. He could have said 0. He could have just as easily said 0. He just made that up. The seller says, I want 5% interest, so your 0 ain't going to work. Okay? You're going to lose too many deals if you get hung up on just 0 interest being the only formula you know. Mr. Watson and I know some people that have done that. He said, if it rents for $1,400, I want my mortgage payment maximum. If it rents for $1,500, I want mortgage payment to be $1,400. He just sort of made that up. Can you make a deal out of this? All right, well, let's carve it up. Sales price $325, $5,000 down. That means that the remaining balance finance is $320,000. If I took out my old calculator and I ran the amortization, I would figure out real quick that $320,000 at 5% interest for 30 years, the payment's about $1,750 a month. How are we doing? It won't work. This is where he called me. He said, Eddie, I'm stuck because it won't debt service and I don't want it. I said, you don't have to take that. I said, recarve it up like this. Do $260 at 5%, that's what they want, at your $1,400 payment on 30 years. How are we doing now? That works? Got all the money covered? Huh? Got a case of the shorts. He says, Eddie, what are we going to do with this other $60,000? I said, you're going to go back to them with what I call a 0-0. 0 interest, 0 payment, due in 10 years. He said, you think they'll take it? And what'd they do? They took it. And I probably could have done a 0-0 on 12 or maybe 15. But he said 10 years is all I need. And I said, okay, that's fine, Kevin, do that. Now let me tell you, there are 20 other things that he baked into the terms agreement of this loan. How many of you have ever been to a real estate closing where a hard money lender or a bank made you a loan? You sign a bunch of documents. What they say, let me just tell you something. These people are going to get tired of that 30-year mortgage payment. I'm just telling you, from buying a lot of seller finance notes, they're going to get tired. And he has a 120-day protection period after he produces a note buyer that undisputed writes a commitment to fund the note. And by the way, can prove they can fund it. Not a we're going to look at it letter, like we're committed letter. Then he has a 120-day protection window that's his time to come up with the money. At that point, he may broker that note to me and make fee income. He may not want to pay his note off at a discount, right? There's all kind of things he can do, and that is what you've referred to as the deal after the deal. And there's always a deal after the deal. So there's a renegotiation because I got 30 years to do it. Now let me give you guys some simple math that you want to understand as you start understanding this process. When you come see me at a class, we're going to take a deep dive on this. If you do not understand what you're negotiating for, you're going to negotiate for the wrong thing. Let me ask you a question. And you are going to raise your hand, work with me on this, because I want the audience to see the vote, okay? And I'm not going to tell you the answer until the end, okay? Because I want everybody to see the survey, because this represents my statement. Which is better? A is a 0 interest rate loan for 9 years fully amortized. Or B, a 2.5% interest rate loan written on 20 years. Which one's better? A? How many of you vote A? Come on, work with me now. Y'all raise your hand. Is everybody else going to vote on B? Is B going to be that big? How many of you vote B? Now you know it's a trick question, and you know that I know the answer and you don't. Right? You're just throwing a dart. All of you taking notes, write this down. The present value of a payment due 15 years from now is worth 30 cents on the dollar today. This is an 8% compound yield, which is very conservative. It's not some wild high number. The present value of a payment due 20 years from now is $200, 20%. The present value of a payment due 30 years from now, today, present value is a dime on the dollar. Do you think if you learn to negotiate and buy on terms, you could crush your competition because you could outpay them every time? If you can't, you're not implementing, because you are only limited to your creativity. That's your only limitation. Look, I've been passionate about this business because I've been able to do one unique thing for real estate investors, and that is I've shown them financing techniques that they didn't consider, that I saw really change their flexibility, their wealth building strategy, their life outcome, and it's a joy to do it. It's been a pleasure and a joy. Thank you very much.